You work hard, you save money, you invest with hope. And yet, it often feels like the market moves in ways that make no sense. You buy, and the price drops. You sell, and suddenly it rises. Sometimes it feels like the game was designed for someone else to win. And the uncomfortable truth is, in many ways, it was. Financial markets are not just systems of numbers, they are systems of human psychology. And once you understand the hidden psychological forces shaping market behavior, something begins to change. Because the market is not simply reacting to value, it is reacting to fear, attention, and manipulation of perception. And the people who understand this quietly operate on a completely different level. Today, we're going to explore the psychology behind how financial markets are influenced and why most investors unknowingly become part of the emotional machinery. Because once you see the patterns, you can never unsee them. But before we begin, subscribe if you want to understand the hidden psychology shaping wealth and power. Most people approach the financial market with a simple belief. If a company is good, the price should go up. If a company is bad, the price should go down. It sounds logical, but markets rarely behave this way. Instead, they behave like crowds, and crowds are emotional. Psychologists have studied this for decades. It's called herd behavior. Your brain evolved to survive in groups. Thousands of years ago, following the tribe increased your chances of survival. If everyone started running, the safest decision was to run too. Your brain still carries this ancient wiring. When thousands of investors rush into an asset, your brain interprets it as a signal of safety, even if the price is already irrational. This is why bubbles form, not because people are stupid, but because the brain is socially programmed to follow momentum. Now imagine another layer added on top of this: information. In theory, markets reward those who understand information best, but in reality, information rarely arrives equally. Some people receive signals earlier. Some people understand how information influences perception, and perception is what moves prices. Think of the market like an ocean. Price is not the ocean itself. Price is the waves, and waves are shaped by wind. In financial markets, that wind is often narrative. Stories about economic growth, stories about technology, stories about fear. When a powerful narrative spreads, money follows. This is why entire sectors suddenly become the future, not necessarily because their value changed overnight, but because belief spread faster than reality. Your brain plays another role here, something psychologists call loss aversion. Studies show that losing money triggers nearly twice the emotional pain of gaining the same amount. The brain processes financial loss in areas linked to physical pain. So when the market falls, your nervous system reacts like a survival alarm. This is why investors panic, not because they lack intelligence, but because their brain is wired to escape pain quickly. And here is where market manipulation becomes possible. When large institutions understand these emotional triggers, they can anticipate how crowds will react. Fear spreads fast, faster than analysis. A sudden drop in price can trigger a chain reaction. Retail investors see red numbers. The brain signals danger. Selling begins, and the drop accelerates. Sometimes the movement has little to do with long-term value. It has everything to do with collective emotion. But here is the deeper realization. Markets are not controlled by one villain or secret group. They are shaped by psychological leverage. Those who understand human behavior can influence the direction of attention, and attention moves capital. News headlines, social media narratives, economic predictions, each one nudges perception. Each one shifts emotional energy, and slowly the crowd moves. But this doesn't mean you are powerless. In fact, once you understand the psychology behind market behavior, you gain something rare: distance. You stop reacting instantly. You start observing patterns. And this leads to a practical framework, not for predicting the market perfectly,
but for thinking differently than the crowd. First, observe emotional spikes. When headlines are extreme, excitement or panic, pause. Strong emotions usually signal that psychology is driving the movement more than fundamentals. Second, slow your decision-making. Your brain's emotional center reacts instantly, but your rational cortex takes longer to process information. Time weakens emotional impulses. Third, question narratives. When everyone says something is the future, ask what assumptions support that belief. Markets often overprice certainty. Fourth, think in longer time horizons. Crowds think in days and weeks, but wealth often accumulates over years. Time filters out emotional noise. If we step back, a simple mental model appears. Imagine the financial market as a giant emotional amplifier. Information enters, emotion magnifies it. Crowds react, prices swing. But underneath it all, human psychology quietly guides the system. Fear accelerates crashes, excitement fuels bubbles, narratives direct attention, and attention moves money. The people who succeed long-term are not those who eliminate emotion. That's impossible. They are the ones who recognize emotion as a signal, not a command. They watch the crowd, but they do not become the crowd. And maybe that is the quiet secret of financial markets. The greatest advantage is not faster data, not complex formulas, but understanding the strange relationship between money and the human mind. Because every market chart, every sudden rise, every terrifying drop is ultimately a reflection of something deeply human: fear, hope, belief. And the moment you begin seeing markets through that psychological lens, you stop chasing every movement. You begin observing, patiently, calmly, almost like watching waves move across an ocean. And in that stillness, you realize something most people never notice. The market was never just about money. It was always about human behavior.